It's not always easy to conceptualize retirement income, and I know it's a challenge that a lot of retirees face. So here's a unique way of looking at things. Rather than working off of a headline budget number, I spend $5,000 a month, $60,000 a year, begin to divvy up your budget into needs, wants, and legacy.
Your needs should be covered by safe investments like Social Security and pensions, that guaranteed income, annuities, high quality bonds, and cash. Things that are really, really safe in any investment environment.
I agree. And then your wants can be addressed by holding some slightly riskier asset classes. And that could be stocks, right? Equities, or maybe some extended sector bonds like high yield bonds, international bonds, emerging market bonds. And then finally, your legacy doesn't affect your life, but what you leave behind. So you can certainly afford to be much more aggressive here and or utilize investments that need a longer time horizon to really pan out. And that could be more growth-oriented stocks, potentially some alternative strategies and things along those lines.
Now that we talked about this, let's talk about how this plays into your financial plan. How does, the plan is a plan, but there's planning behind a financial plan.
Right.
And this is the variable inside of your plan.
So, right, so you raise a good point. One of the things that we always focus on, and it's kind of a nuance that I've noticed, but one of the things we look at is retirement fitness. That's what we call it, retirement fitness. And what it essentially is it is the amount of guaranteed income that someone has, which is basically, what's guaranteed income? Social Security, if you really want to consider it guaranteed income, pensions, and annuities. That's it. Those are the only three potential sources of guaranteed income. So this statistic that we look at is guaranteed income divided by basic expenses. And Tony, what are basic expenses? Needs, right? Exactly. So we've found out that whenever our threshold is 60%, we want to be at 60%. We want to make sure that 60% of our needs are covered by guaranteed income sources. And what we found is that when we're below 60%, there's one stress test that almost always, close to 100% of the time, breaks that financial plan and takes that Monte Carlo below 70%. And that happens to be the bear market stress test. What do you want to explain what the bear market stress test is?
Right. So the bear market stress test in our plans is the day you retire, the stock market's down 20%. Why is that significant? Because you're starting to create your income for retirement. And if your assets are down, you're basically selling low. You're locking in those losses to grab income because you don't have a lot of those guarantees helping you pace out your dipping into your portfolio.
Right. And it is a fact that has been proven time and time again that bad returns early in retirement are much more detrimental than those same bad returns later in retirement. If you took 25 years of returns and you had some bad years in the beginning and good years on the back end, and you applied those to someone's portfolio and then completely reversed them. So now all of a sudden all the good years are up front and all the bad years are on the back end. What you'll see is that when the good years are on the front end and the bad years are on the back end, they don't run out of money. Right? The portfolio continues to thrive. Right. But when you're getting hurt early on, it really crushes you. So that's kind of the key number that we want to focus on within the retirement plan as it relates to this is 60%. We want to make sure that we get at least 60% of these needs-based expenses covered by guaranteed income sources. When we're able to do that, we're able to sustain a bear market. Another way to look at investment strategy, risk, and time horizon is the three-bucket strategy. Again, I've mentioned this before, but there's this huge misconception that when you retire, your time horizon is zero. That's simply not true at all. We have to make sure that your money continues working in the most effective manner possible for 15, 25, hopefully 35 years. So this three-bucket strategy is just a different way to look at things. So you have three different buckets. You have a near-term bucket, an intermediate-term bucket, and a longer-term bucket. The near-term bucket, the purpose of that really is to provide you with income over the course of the first 5 years. Because that's providing you with income potentially immediately, those funds need to be invested very conservatively. In the next bucket, we have the intermediate term, which really covers years 6 through 10. So we can invest those, I'll call it moderately conservative. And that could be maybe some high yield bonds or some dividend paying stocks. And then we have the longer term bucket, which is 10 plus years out, and that's where we can be a bit more moderate. Dividend paying stocks, maybe some growth stocks. The key is to figure out how much goes into each bucket to begin with so that the buckets can continue to refill themselves every 10 years. So what's happening here is as we spend down the near-term bucket over the course of the first 5 years, we will then move into spending down the intermediate-term bucket over the course of years 6 through 10, and we have now given the long-term bucket 10 years to grow and then refill the first 2 buckets so that we can do this process over and over again. How well are you managing your wealth? Are you taking advantage of all opportunities that are available to you? Just as it makes sense to have regular physical checkups to make sure you're maintaining optimal health, it also makes sense to do a regular checkup on your financial situation. Our Wealthalize tool provides you with that diagnostic. Simply complete our online questionnaire in under 15 minutes. Our proprietary software will analyze your investment strategy, tax situation, asset protection, estate planning, charitable giving, and your professional relationships. You'll immediately receive a score ranging from 0 to 100, which assesses your situation. Additionally, you'll receive a SWOT analysis, which identifies your strengths, weaknesses, opportunities, and threats that could impact your wealth management. Visit today, www.wealthalize.com.